Welcome back to the Token Launch Masterclass. This is episode 3, and we're diving into a topic that, frankly, too many founders get catastrophically wrong. We're calling this one the cap table conundrum, structuring for a decade, not a demo day. Look, I get it. You're trying to close your first round, and the pressure is on. It's tempting to see your token distribution plan as just a spreadsheet to make an investor happy. That's a huge mistake. What I see time and again is that this document isn't just a fundraising tool. It's the constitutional DNA of your project's entire economy for the next 10 years. Get this wrong, and you've built in a self-destruct mechanism from day one. So today, we're going to explore how to avoid those short-term traps and architect a token ecosystem that's actually built to last. All right, so let's get on the same page. When we talk about a cap table or a token allocation schedule in Web3, it's fundamentally different from a traditional equity sheet. The first thing to grasp is the basics. Total supply, which is every token that will ever exist, and circulating supply, the tokens active in the market today. But where the strategy really comes in is how you divide that total supply into buckets. The way I always approach this is to think like a city planner. You wouldn't build a city by just giving out land randomly. What I find works best is to zone it with intent. You have your commercial zone. That's for investors. Your industrial zone is for the team, the builders. The residential areas are for your community. And crucially, you have public parks and infrastructure. That's your treasury and ecosystem fund, built for the long-term health of everyone. Each one needs to be sized and planned perfectly. This is where we hit the first major fork in the road, and it's what I like to call the demo day trap. It's that siren song of optimizing for short-term hype just to get that first round closed. You might find yourself thinking, let's just offer big discounts and a 6-month lockup to this VC. We need the cash. Or on the flip side, we'll only take 5% for the team. It'll look great to the community. The issue with both of these paths is they create misaligned incentives. What I've seen time and again is that this leads directly to a post-launch mercenary dump. The moment those tokens unlock, the early holders who got a sweet deal have no reason to stick around. They sell, the price collapses, and the genuine community you're trying to build is left holding the bag. It's a devastating and entirely avoidable momentum killer. So let's talk about the first and maybe most personal slice of the pie, the team and founder allocation. What I typically see and what I advise is somewhere in the 15 to 25% range. This seems to be the sweet spot that rewards the core builders without looking extractive. But the percentage is only half the story. The real signal, the part that separates the tourists from the true believers, is the vesting schedule. The gold standard here is a 4-year vest with a 1-year cliff. So, what does that actually mean? The 1-year cliff means you get absolutely nothing for the first 365 days. After you cross that 1-year mark, a quarter of your tokens unlock. Then the rest drip out, usually monthly, over the next 3 years. You might see this as restrictive, but what I find is that it's actually a powerful statement. It's your way of telling the market you are committed for the long haul, ready to build through the bull and the bear. It's the ultimate sign of conviction. Now let's walk through the investor and advisor bucket. This is always a delicate balance. What I find is You're trying to secure that vital early capital without giving away the farm, causing what we call excessive network dilution. And remember how we just talked about team vesting? Well, what I always emphasize is that investor vesting schedules are just as important. The last thing you want is a coordinated sell-off right at your token generation event, or TGE. A unified long-term vesting schedule across all your early backers prevents that massive selling pressure. And briefly, on advisors, I like to treat their tokens as smart equity. It's not a payment for a logo on your website. It's compensation for tangible, ongoing value. You might find that vesting their tokens based on milestones or over a year or two ensures they're truly aligned with your journey. Okay, now we arrive at what I truly believe is the engine room of any decentralized project, the community and ecosystem fund. If the team is the blueprint and investors provide the foundation, this is the power plant. What I like to see in this bucket is a really diverse set of tools. You've got airdrops, which are your way of rewarding your earliest, most loyal believers. You have liquidity mining and staking rewards. That's the lifeblood of your on-chain economy. Then, what I find is crucial are grant programs to attract new developers to build on your platform, and marketing bounties to help spread the word. You might find it helpful to think of this fund not as an expense, but as fuel. This is what you use to bootstrap those crucial network effects. It's the single most important allocation that helps you transition from being just a project run by a core team into a true, self-sustaining ecosystem that can thrive on its own for years to come. So, if the ecosystem fund is the engine, I like to think of the Treasury as the project's permanent war chest. It's the long-term endowment that, eventually, should be controlled by your token governance. You might find it's the most important safety net you have. What I like to see this bucket used for is funding ongoing core development, paying for those critical trust-building security audits, and hiring key talent down the line. It's also your source for providing deep initial liquidity on exchanges, and, crucially, it's your emergency fund for a crisis. When a black swan event happens, a well-funded treasury is what gives a project the resilience to survive. This isn't just about lasting until the next bull run. It's what gives you a real shot at thriving for a full decade. All right, now we need to talk about the ghost in the machine, emissions and inflation. You might find it helpful to think of it this way. Every single time a team member's tokens vest or a liquidity reward is paid out, that's an emission. That's an emission. It's a new token entering the circulating supply. What I always do, and what I urge every founder to do, is to map this out in a simple spreadsheet for the entire 10-year journey. You want to see that curve. What you're looking for is a smooth, predictable emission schedule. The alternative, which I see far too often, is a cliff-heavy model, where huge chunks of tokens unlock on specific dates. All this does is paint a giant target on your calendar for traders. They know a wave of sell pressure is coming, and they'll play against it, which almost always ends up hurting your most loyal, organic community members. So, let's make this practical. This is the moment where theory becomes strategy. What I want you to do, either now or after the show, is to actually open a spreadsheet and chart out that 10-year journey. You might start by asking yourself a few critical questions. First, what percentage of the total supply will be liquid after year 1? What does that look like after year 4 when early vesting ends. And then, what about at the decade mark? Next, what I find to be a crucial step is to identify who the primary sellers are likely to be at each of those stages. And maybe the most important question of all, when does the community, through your ecosystem fund, actually become the majority holder? This exercise is what turns a simple pie chart into a concrete, long-term strategic plan. All right, theory is great, but let's look at how this plays out in the wild. You might find it helpful to look at two archetypes. First, what I call the good. Think about some of the most successful, resilient protocols out there. What I almost always see is a massive allocation, maybe 50% or more, dedicated to the community and ecosystem fund. And their team and investor tokens, they're locked for years. The outcome is a vibrant ecosystem where builders and users feel like true owners. Now let's look at the ugly. We've all seen these charts. A massive spike at launch, followed by a vertical drop. What's behind that? You might find it's a project that gave huge discounts to private investors with a 6-month lockup. The moment that cliff hits, a tidal wave of tokens floods the market. The project never recovers. It's a stark reminder that your token plan isn't just a document, it's a predictor of your future. So we've gone through all the mechanics, the percentages, the vesting schedules. But what I want to leave you with is a shift in perspective. You might find it powerful to stop thinking of your cap table as just a financial spreadsheet. What I believe is that it's your project's manifesto. It's a public declaration of your values. When you publish a clear, well-reasoned blog post that explains the why behind these numbers, why the team gets 20% with a 4-year vest, why the community fund is so large, you do something incredible. You take what could be a source of fear, uncertainty, and doubt, and you transform it into your greatest strength. What I see is that this level of transparency builds immense trust and credibility. It tells the world you thought deeply about fairness and longevity. And that's a signal that attracts the right kind of long-term community members. All right, so let's bring this all home. If you remember just a few things from today, I hope it's these. First, what I always stress is that you must structure for a decade, not just for a demo day. Second, you might find that your most powerful tool is vesting. Use it to align every single stakeholder. Third, what I like to see is a massive, generous empowerment of your community. It's your best investment. Fourth, meticulously model your emissions so there are no surprises. And finally, be transparent about it all. Your cap table is your manifesto. So now that you've architected your project's internal economy, the next question is, where on earth to build your headquarters? Join us next time for episode 4, Jurisdictional Arbitrage, Choosing Your Legal Home Base.